I'm Ian from Venturepreneur Network. Today we're going to be talking about small business loans. We're here with Mark Rockefeller, the CEO of Streetshares. Mark, how's it going?
I am doing well, Ian. It's great to be on.
Yeah, it's great to have everybody on here. I know small business loans is something we get asked about all the time for our audience of entrepreneurs and for the National Veteran-Owned Business Association. So we wanted to cover it with you. You're the expert. You've been doing this for a long time. So, I kind of wanted to first, we polled our audience and we said, have you ever taken a business loan? And so far the answers that we're getting are, I haven't considered it and no. So it looks like most of the folks on here are looking at what is a business loan, how is it done? So we're going to tailor that. We're also going to touch on folks that may or may not have taken a loan before. So we're going to also open up another poll to the audience here, and we'll kind of let you get started here and talk.
Okay, perfect. Yeah, my name is Mark Rockefeller. Thank you, everyone. It's great to be on. Thankful to Innova for sponsoring this series. I looked at the lineup of speakers, and it's really a great group of folks that are going to be doing this series here. So Ian and team have done a great job setting up this series of seminars, of webinars, and we're just delighted to be a part of it. First of all, I want to thank everyone for being veterans, for your service. We're a veteran-owned company ourselves, and if you're not aware, you are a part of a really, really exciting veterans entrepreneurship movement that is going on right now in America. It's a bit under the radar. It's something that we should be talking about a lot more. In fact, I actually had lunch today on Capitol Hill with some congressmen talking about this very thing. But what you are doing, your service to your country in the military, and then to start your own business, and now what I call your second service now as a business owner, creating jobs, creating goods and services for the economy, is a national service. And it's something that is so desperately needed. And I'm just a huge fan of veterans entrepreneurship. I think it solves problems that plague the veterans community. I think it solves problems that plague our economy and our country. And any veteran entrepreneur is a friend of mine. So I just thank you so much for having the courage to step out and serve your country in the first place, and then serve it again as a business owner. I just think it's very admirable. So thank you for being here. Thank you for giving me a very brief chance to chat with you guys. I do want to keep it fairly short. I'm going to run through some points here, and just really try and focus on, if I'm in your shoes, I want to know, I need funding. What kind of funding should I get, and how do I sort through all these options? And so my aim is to be as educational and transparent and open as possible. And I look forward to your questions here, both as we go through. My understanding is that you can actually chat those questions to both Ian and me. We'll be able to see those, or you can message Ian and he'll pass those along. But we'd love to have the chance to answer those as we go through, or of course at the end we'll have a Q&A as well. Very quick sort of background on me, and I'm actually going to pull up a slide here, so bear with me 1 second while I get this thing going.
And while you're bringing that up too, we have the poll question that you asked us to ask here. Have you ever used Uber, Airbnb, or Amazon? 100% of respondents have said yes, or of course everyone has. So looks like a little confirmation there.
Okay, very good, very good. All right, want to confirm that you can see this slide deck here that I have. Can you guys see this title slide, Small Business Funding Loans?
No, I don't.
No, all right.
It's still video.
Let me make sure that I'm properly sharing this.
Yep, good to go.
Okay, here we go. All right. Quick background here on me and a bit of context as to why we're doing this. I was in the Air Force for 9 years. I was a JAG officer most of that time. And then I left and I went to work at a Wall Street law firm called Milbank, Tweed, Hadley, and McCloy. And I worked on the Lehman Brothers issue. When I left the military, so I came back from Iraq in the summer of 2008. And as most of you know, that was the year, that fall, when the financial crisis really started. And so what I realized was I was representative of a generation of veterans, many of you, I assume, are in the same generation, who wanted to be entrepreneurs, but for whom their separation of service came in the wake of the financial crisis, right? That is, we want to be entrepreneurs, but our timing is awful because we just had this major economic crisis and banks are not giving us the capital that we need to launch our businesses. It was trying to solve that problem that I created Streetshares, my current company. So I'm the CEO and co-founder of Streetshares. We are a 3-year-old startup business based outside Washington, D.C. in Northern Virginia. We've got 25 employees. We've raised about $9 million in equity capital and about $200 million in lending capital. And our mission is to fund veteran-owned small businesses with loans. It is to lend to veteran-owned small businesses. So we can talk a bit more about what we do later on if you'd like, but I want to start with a bit of historical context. The picture that you see right here, this is VJ Day. So this is the end of World War II, 1945. So people are celebrating. There's ticker tape parades. Sailors are kissing nurses. You get the idea.
Next slide, Mark.
Okay, you got it?
No, it's still on title slide.
Interesting. All right, so I'm advancing my slides, but you guys can't see those. Let me do this. How's that?
I see your mouse moving. It's not technology if it's not working.
Let's see here. That is interesting. So it is stuck on my first slide. We will just skip this. How about now?
Nope.
All right. You know what? Let's just skip this and move on. So what you would be seeing is a great black and white photo of people cheering in Times Square on VJ Day. And the point of this picture is on the next click, it would show you a graph, and it would show you the number of banks that existed in 1945 and the number of banks, how they grew from that point on. And the bottom line is that there was a lot of banks. They were small banks. They were community banks. They were focused on serving the small business community. And those banks no longer exist. The next slide would have showed you a picture of kind of the Iraq and Afghanistan generation of veterans, and we would have compared that chart, the number of banks that were serving Main Street then and the number of banks that is serving Main Street now. And back then there was about 15,000 of them. Now there's about 6,000. And as folks know, those banks are getting bigger and bigger, and therefore they are more removed from Main Street. So the bottom line is that banks are having a harder time lending to small businesses. Those of you who are small business owners probably feel that, and you probably sense that. That was in essence the genesis behind the Streetshares idea and why we stepped up to create something to solve that problem. And uniquely, our model allows fellow veterans and members of the military community to make investments in the loans that we make to veteran-owned businesses. So like we did overseas, veterans rely on each other, right? We came back home, the banking system isn't working for us, and so we're going to rely on ourselves. So we have this network of veterans funding veterans, veterans making small business loans to each other. The Uber question that we asked was to get to the point that back then in 1945, banks worked in a certain way. They collected deposits and they made profitable loans. Since then, nearly every aspect of American life has been changed by technology. Right? We've all used Ubers instead of taxis, Airbnb instead of hotels. We've used Amazon, of course, instead of Blockbuster Video, or even Redbox now is getting out of date. Everything is changing with technology, but banking fundamentally hasn't changed. Technology has sped up banking. It's made it a bit easier. Most of us are USAA members, and we can make our deposits electronically. But the same basic model of banking, that is they take in deposits and they make profitable loans and they suck up that big amount of profit in the middle, is still the same as it was in 1845. The Streetshares model is to come in with what is in essence Uber for banking, right? It allows people to lend to each other, lend to veteran-owned companies through their phone very quickly, very easily, and allow lenders of money and borrowers of money to connect directly using their mobile device. That is simply the sort of the basis behind Streetshares and why we're doing what we're doing. I want to fast forward very quickly and just I want to hit 7 truths of small business funding. This is the meat of the presentation here. 7 basic facts that I think if you walk away knowing these things, you'll have a good idea of when a loan is right for you versus an equity investment. I know that we have Brandon Shelton from TFX Capital, which is a veteran-focused venture capital fund, speaking to you, I believe, next week.
Tomorrow.
Tomorrow, wonderful.
Yeah.
Okay.
Tomorrow afternoon.
Actually, Brandon invested in Streetshares. He was actually in my office this morning, and so we were chatting about this. So great guy. You will really enjoy his presentation, and that's going to be focused on equity investing. I'll focus on taking out a loan, and I want to help you walk you through when you know which of those 2 things you should do, right? So very simple, 7 truths of small business funding. Please write these down. If you have these down, then I think you'll have a pretty good idea of what kind of capital you'll need. So
I'll record it in chat and we'll send it out afterwards.
Wonderful, perfect. All right. So truth number 1, your business needs capital to grow. That seems fairly obvious. Everyone has heard the saying that it takes money to make money. But this is the most fundamental thing, right? You have to spend money. You have to market. You've got to produce a product. It takes money to grow your business. Even if your business is already going, and even if your business is on a net basis profitable, if you want to grow that business, you need to get capital to do it. You might be able to do it from your own revenues. There's something called retained earnings, right? This idea of instead of taking the profit that your business makes and distributing that to the business owners, you keep it inside the business so that you can grow. But any way that you come by it, you need capital to grow. Just a basic fact of business. Number 2, capital comes in basically 2 forms. Form number 1 is a loan, and form number 2 is an equity investment. That is, either you borrow the money that you need to grow, or you give away part of your company in exchange for that money. We've all seen Shark Tank, where there's negotiations about, I will give you 25% of my company for a $200,000 investment, right? That is equity, right? That is giving away a portion of your company in exchange for some capital to grow. The opposite is a loan, right? A loan is, I'm going to keep all of my company, 100% of it, but I'm going to borrow money from you, knowing that I've got to pay that back in some period of time on some interest rate terms. There are pros and cons to these 2 approaches. The primary benefit to a loan is that you can usually obtain it much faster and that you retain control over your business. The primary benefit to equity is that you don't have to pay it back. So if your business does not work out, if your business fails, then that equity investor loses their money and you don't owe them anything further. So the trade-off basically is between sort of control and risk over loss. But in essence, there's 2 ways to get the capital that you need to grow, either a loan or an equity. That is, you sell a portion of your company in exchange for some capital. And Brandon from TFX will talk about that. I would footnote here that there are, I guess, other ways, right? There's very, very rare, but there are a few grant programs out there. Streetshares has one. There's the rich uncle. There's your own money. There's things like that. But by and large, if you're looking to grow, absent some of those outlier things, crowdfunding, for example, is an outlier. You need either a loan or equity. Truth number 3.
No, I was just going to say
yeah.
a quick pause there. People talk a lot about friends and family, and I had an entrepreneur say to me, I don't have any family, and my friends definitely wouldn't lend me any money.
Right.
And I think that's kind of one of the things that entrepreneurs face is if people are like, well, go raise a friends and family round. That's something that either they can't do or they don't understand that that's their soft network of individuals or whatever. But by and large, those folks are either looking for equity or they're lending them the money. So they still kind of fall in one of those categories, right?
Yeah, exactly right. Exactly right. Yeah, the only things that would fall outside of these two categories would be rewards-based crowdfunding, right? So you go on Kickstarter or you go on Indiegogo and you offer people a T-shirt or concert tickets or whatever it is in exchange for some, some capital. It's a very hard way to raise a lot of money. It has worked successfully where folks can, in essence, offer early product. That is, I'm in my basement inventing the next widget, and I can say, all right, $500 on Kickstarter, I'll give you the first widget. So kind of a pre-sale of products. It has worked in that way. And then there's grant programs, either private grant programs or from the government, which are in essence free money. But absent sort of rewards-based crowdfunded capital and grant programs, nearly every other source of capital, be it an institutional fund, a professional investor, or your own friends and family, you're absolutely right, Ian. It's going to fall in either the category of a loan or equity, right? Either you're borrowing it with the obligation to pay it back, or you're giving away a part of your company for that money. Those are really the only two options. All right, truth number 3. Equity investment capital is only an option for a few businesses. Equity investment capital is only an option for a few businesses. And the reason why I say that is there's 2 categories basically of businesses that will be able to raise equity capital like you see on Shark Tank. Number 1, high growth tech companies, right? In the real world. These are companies where a venture capitalist like Brandon, who will talk to you tomorrow, will look at your company and say, great, I see the potential for growth here. I realize that you're not making money yet, but I think you can with my help. And so here's some money. I'll take some portion of ownership in your company. And the way that works is those venture capitalists are doing that to a whole bunch of companies, and they're building up their own little portfolio of venture investments. They have to have a certain portion of those investments work out. And so they will only do that for companies that they think are high growth companies. What that usually means is that technology focused companies, fintech, healthcare tech, education tech, software, cybersecurity, companies like that have a decent shot at getting equity investment capital. Most others don't. So, the majority of veteran-owned small businesses are service companies, right? They're IT services. They are, plumbers and mechanics and, bakeries and, all the main street businesses that we see that make America great. Veterans own a lot of those. Those are really not great candidates usually for equity investment capital. I'll defer to Brandon and let him tell you more about that tomorrow. But I think generally you would find that there's only a few kinds of businesses that are a great candidate for equity investment.
And do you think that things like Shark Tank and things, different type of kind of programs or shows or different things have kind of convoluted the message there? Because a lot of times they're investing in physical products. Yeah. Or different things that are something that like can scale, but it can scale because it's a widget, right? So it's something that you can sell 50 of, or you can sell 5 million of. So that's why they're investing, because there's that upside there. But traditionally, VCs are not going to ever invest in those. The reason why the sharks do that is because they have a platform in which they're reaching millions and millions of people that are going to buy those goods, which most VCs don't have.
Yeah, that's exactly right. So just appearing on Shark Tank, if I'm selling T-shirts, just appearing on Shark Tank means that I'm going to sell a lot more T-shirts. And so it works out for Mark Cuban to go ahead and, back that business because right now, as they appear on TV, they're getting a whole bunch of free marketing, right? Yeah. So that's absolutely right. One of the great stories that we tell here at Streetshares, one of our earlier success stories, is a great veteran-owned company called Combat Flip Flops. And I assume many of you have heard about it.
Well, and we did an interview on Vetrepreneur Network with Combat. I'll post it in chat.
With Griff?
Yeah, with Chris and
very cool.
Yeah.
Griff's an awesome guy. And for those who don't know the story, Combat Flip Flops was founded by a guy named Matt Griffith, that goes by Griff. Griff and his co-founder were Army Rangers in Afghanistan. They went back to Afghanistan, and there was this factory there that had been the workers had been displaced from the fighting, and so they repurposed that factory to make flip-flops for Americans. Griff actually got his first business loan from us at Streetshares. It was a small business loan because they were fairly new and didn't have a whole lot of sales yet. Griff then got his big break, which was an article in Gizmodo that got him a couple 100,000 views and a whole bunch of orders. He called me up the next day and he said, "Mark, thank you. We could not have done this without you guys." And the reason why we were able to lend to him and really no one else was the banks weren't willing to because of where he manufactured. Their sort of catchphrase is they make cool things in dangerous places. And so he makes, flip-flops in Afghanistan and, bracelets from landmines in Laos and on, all these very, very cool products, but they're made in these dangerous places. And so the banks wouldn't lend to them because of the insurance issues associated with their manufacturing locations. But we did. Fast forward then about a year, Griff goes on Shark Tank. There was a veteran-focused episode of Shark Tank last, I think, February or March.
Yep, February.
And there were, 4 companies on. I think 3 were veteran-owned and 1 was military spouse-owned. 2 of those 4, we funded on Streetshares to get them there, which was very, very cool, to include Griff. And then during the course of the show, we ran funding auctions for all 4 of them. And gave all 4 loan offers within about 15 minutes. And then my guys got on Twitter and they were taunting the Sharks about how we could fund them, but they couldn't, and things like that. It was a lot of fun. So it's a great example of, Griff had a very compelling product. His appearance on Shark Tank necessarily meant sales, and so they could do that kind of investment, equity investment. Generally speaking, the sale of merchandise like that is not going to be a great candidate for equity investment, at least from professional investors, right? You might have individuals, your friends, your family, individual angel investors who would be willing to do that. But most professional investors would be focused on tech type companies in order to make an equity investment.
Well, and when I talked to Griff and Donnelly, in that I was like, if you're walking around talking to VCs, and like I'm in and around Silicon Valley all the time, saying, we want to raise $200,000 for, to make flip-flops in Afghanistan. I was like, how many people thought you were crazy? And they're like, oh, everyone thought we were actually crazy. Right. And that's because, and this is something that I think that vets specifically that we talk about all the time, where you bake social impact into your company. And obviously, as you've done as well, when you're baking social impact in the company, you're not only selling the vision of where you want to go and what you want to do, you're also selling the product and the leadership team. And that's an extremely hard sell to an investor that's like, how am I going to make money off of you?
That's right.
And that's the difficult sell. And we see that all the time. The Rumi Spice team, same sort of thing, where it's just, hey, this is risky, so I don't really want to see it. When in reality, it's brilliant, and folks can't necessarily see that, especially institutional investors.
Yeah, that's right. These VC really don't account for social impact or social good. They have what are called limited partners. So big, wealthy, wealthy folks, family offices that give them their money to invest for them, and those folks expect really, really big returns. And social impact is usually not a part of that equation, unfortunately. So, okay. So, truth number one: your business needs capital to grow. Truth number two, capital comes in two forms, either loans or equity. Truth number three, equity investment is usually only an option for a few kinds of businesses. Truth number four, borrowing money, loans, is almost always an option for businesses depending on their stage. So unlike equity, that's only an option for a few, borrowing, taking out a loan, is usually an option. But it does depend on your stage. You'll probably have to wait until you are a little bit later stage in general. It's very hard to make a loan, a pure loan, to a brand new startup because that startup business does not yet have cash flows that can give the lender some confidence that they'll get paid back in time. If you go to a bank, for example, most banks will not make a small business loan to you until you've been around for a couple of years. And have usually 200-300K in revenue. That's quite a bit. It's quite a bit. And so bank loans are very good for businesses that are a little more mature. But if you're on the earlier stage, a bank loan is not going to be a great option. There are folks who will lend to businesses in the earlier stage. Streetshares is one of them. Although for us, you do have to be around for 1 year and have at least 25K in revenue. So if you're a pure startup with just an idea and a PowerPoint deck or a prototype but you haven't sold anything yet, that's the hardest phase at which to find capital. Right, because there's no cash flows yet to give lenders comfort that you'll pay them back, and unless you're a kind of a tech company with a really, really high potential for very, very fast growth, the equity investment as well is going to be tough. We can talk a bit in the Q&A about some of the options that are available to folks that kind of fall in between these things. But truth number four, borrowing capital, that is loans, is usually an option for most businesses. But it may have to wait until you are at least a couple of years old. Truth number five, small business loans are very confusing. And this is a really, really important point. I don't want to bore you with sort of legal stuff and regulations, but the bottom line is that small business lending is very lightly regulated, and it's usually done at the state level. There's a whole bunch of ways that you can give a small business loan. It depends on the kind of business that it is and what that business has as collateral. Can I make a loan to a business based on that business's real estate or their inventory or some machinery that they have? Can I make a loan based on receivables that they have? There's something called merchant cash advance, which is if you are a retailer and you take credit card receipts. There's a kind of loan where, in essence, they will give you money and buy those receivables from you. So they'll give you, 30K, 50K, whatever it is, and then they'll take a portion of your receivables, of your credit card receipts, as they come in until that loan is paid back with interest. So there's so many different ways that you can fund a small business with a loan. And there's so many different regulations depending on the states that it can be very, very confusing to sort all of this out. Truth number six, some lenders aren't really lenders. Some lenders aren't really lenders. And what I mean by that is there are a whole bunch of folks, if you Google, go on right now and Google small business loans, you are going to see a whole bunch of ads from a whole bunch of different companies. Sorting through those and figuring out which are actual lenders and which are simply loan brokers is a very difficult thing. So what a loan broker does is they take your application for a loan and then they work with a whole bunch of different lenders, and usually they pass that application on to the lender that pays the broker the most for your loan, right? For your referral. That is typically how that works. So they aren't actually making the loan. They take no risk. They're going to shop it around and try and find someone who will lend you money, and that someone is often whoever will pay that broker the most. That broker also can add some fees in, right? That is, they're going to charge that lender in order to refer you to them, and so that charge gets passed on to you. That being said, these brokers can also at times help you find a good deal, but it's very difficult for you to figure out who are actual lenders and who are simply brokers. Mix in government programs, SBA loans, Patriot Express loans, bank loans, and non-bank lenders like Streetshares, and it just gets really, really confusing. So that brings us then to the final truth, number 7, and it's kind of a framework to help you think about, should I take a loan from this person or not, and what kind of rates are fair, what kind of rates are reasonable. I would say that we have funded, we've given loans to over 300 veteran-owned small businesses in the last about 20 months here at Streetshares, and we have seen some of the other loans that they're getting, and some of these are simply predatory. I mean, they're not the kinds of loans that are going to help a business. All of us in the military have some context or some frame of reference for payday type lenders, right? They usually kind of existed just outside the gate, next to the pawn shop or the auto title lender, and we've seen young airmen, young Marines, young soldiers go and borrow more than they should or get themselves in over their heads. Unfortunately, those folks have now gone online, and those folks have now moved into the small business market. And so there are a lot of these predatory type lenders out there. So the 7th truth, the final truth, is some loans are predatory and some are beneficial. Some loans are predatory and some are beneficial. And I'm going to talk you through a little bit how you can tell the difference. First, try best as you can to get a total cost to borrow number out of the lender. There are some real games that are played by some of these lenders in which they kind of play hide the ball with the actual cost of the loan. An example that we saw here at Streetshares, for example, was it was a veteran, Navy veteran, catering company. And the guy took out 2 loans from Streetshares. It was a great bar, great company, and paid off the first one. He got a second one, and he got an offer in the mail from one of these lenders that promised this really, really low rate. And so he took it. And unfortunately, he didn't call us first and kind of help, allow us to help him kind of make sense of the fine print. But he took it and basically refinanced our loan with this one, which he thought was a low rate. He called us back up after a couple of weeks when the payments began to hit. We calculated the effective APR, so the annual percentage rate for him, and I believe it was 83%. Which is quite shocking. We have seen APRs in the triple digits,